What a day today in the markets and for bonds. If you look at TLT here on your chart, down another 0.5% today. The sell-off in bonds is getting even worse. Now, a lot of people don't know, but the bond market is a lot more important than the stock market. The bond market is 2 to 5 times larger than the stock market, depending on what point in history you're looking at. And what you're seeing in the bond market is, as JP Morgan's head of fixed asset management calls it, a de-anchoring of yields and expectations. This is dangerous. And he believes we're at a point where something could break any day now. Yeah, you really can't make this up. We have that clip for you, as well as a clip from Nick Timmerhouse talking about a hard landing, and the odds the Fed raises rates again is pretty much non-existent. So those are, I guess, pretty worrisome clips that I want to bring to your attention from some of the most important people out there. As you know, Nick Timmerhouse is seen as, to some degree, the Fed's mouthpiece. He kind of communicates for the Fed, at least so it seems. Now, tomorrow morning, we have massive economic data coming out. This data will be vitally important for our markets and what happens in the bond market. The bond market has been especially fixated on the data, and the bond market on the long end, the 10, 20, 30 year, is starting to say, hey, we might not get rate cuts for a long time. We don't know how high we should set these yields. We don't know if we're ever going to get rate cuts, is basically what the bond market is starting to say. This puts massive downside pressure on equities, and tomorrow is probably the biggest data point that we'll get for the bond market. So I want to go over what the markets are expecting, what I expect, and what could happen to some of our favorite stocks like a Tesla. If the worst case possible does start to play out and the bond yields continue to rise and really continues to get de-anchored from any expectations, even possibly going higher than the federal funds rate, what would that do to Tesla? What could that do for our markets? Well, the guy that used to run Tiger Global says the equity risk premium says the S&P should be 23% lower if you're looking at the 5-year treasury, and about 40+% lower if you're looking at the 10-year treasury, based on a 50-year average. So could be quite the downside, but there is obviously a bullish potential outcome for some of our favorite stocks like a Tesla. So I do, to some degree, apologize for the long intro of this video. Quite a bit that I want to get you guys preconditioned for. We'll obviously break it all down, and we're going to go ahead and get straight into it, look at some technicals as well on Tesla and some option activity. So if you're ready, let's get into it. Hit the like button and subscribe to the channel if you like to make money and you want to make more of it. If you want to stay up to date every single day with what's going on in our markets, that should help you make money, as you will be more informed after watching this channel. Well, hit that subscribe button as well as like the video if you guys want to come actively hedge out your portfolios. If the worst possible scenarios happen, you're going to be in the best possible position to capitalize on that if you are with us in the trading community. Link down below in the description of this video. So I want to start this video with something that's really vital that everyone understands. So when you're thinking about the real economy, when you're thinking about the odds of a soft landing or a hard landing, or just restricting the economy, the Fed raising rates affects the short term. The Fed saying higher for longer, the Fed's trying to affect the long end of the curve. If you look at the 30-year treasury, the Fed has raised rates once since July. Well, your yield back in June, July was about 3.8%. The yield today on the 30-year is almost 5%. So the Fed has effectively communicated to the long end of the curve, the 30-year bond, that we're going to be higher for longer. This puts real pressure on the economy. Because imagine it like this. If a bank is evaluating you for a 30-year mortgage, they're not giving you a rate based on the 2-year treasury or the 5-year treasury. They're giving you their rate based on the long end of the curve. So when the long end of the curve does start to rise, that puts a lot of pressure on actual investments in the real economy, what you're going to pay for loans, so on and so forth. So when the long end of the curve does rise, your 10, 20, 30-year bonds, that puts a lot of pressure on the economy. That does drastically increase the odds that something bad will happen. And we're going to run this clip from the head of JP Morgan's asset management division, and he says that something breaking could happen any time now. Literally any day.
Call long rates, is it too much to say that they're unmoored at this point?
They became unanchored 2 weeks ago. What I'd like to see is the employment data. If the employment data Friday comes in around expectations and the market rallies a little bit and then sells off, that tells me there's more of a washout yet to come.
How long have you been doing this? A long time, Bob?
Too long.
So you probably got a lot of money after all this. Would you bet the house that we don't see 8%?
So
you're taking a long time.
I am so grateful that the head of our bank isn't drawn into my world of trying to guess the next 50 basis points from the Fed.
Is it completely impossible that in the next 5 years we go significantly higher? Or?
Oh, no, not at all. And I think certainly that was a stress test to the market, and the bank has to be prepared for
When
that.
do things break?
When do things break?
Something break.
Well, I think we've just delivered another rate shock to the system. I don't know about central business district, commercial real estate. That hasn't been solved yet.
Could be any day, is what you're saying? We're there already? Are we at a point where there is some stress we don't know about under the surface?
Well, we knew 6 months ago that rates at those levels took out the regional banking system. Definitely these rate shocks create some sort of stress. I'm all on board that the last 15 years weren't normal, that we're going back to something that looks like pre-financial crisis. I don't know that you get there all at once. After all, it took 27 years to go from 20% down to 0%. I think the Fed has raised rates high enough here. I think recession is in the frame around year end into the first quarter. I actually think they'll end up cutting rates to 3% over the next couple of years.
You're saying things that you're being very definitive. Have you thought this through? And you really just said a lot of things. So
I have to think it through.
So we're going to have a recession is in the cards. There will be a cut next year. They're done raising for now.
That's certainly the way it looks to us. Inflation is already at their target. You take core personal consumption expenditures the last 3 months and annualize it. So that's your current run rate, 2.16%.
Do you have a boss? You're going to get taken to the woodshed. You are. When you go back there today, they're going, Bob, what were you thinking? You actually said some things. Well, we get to, those are a lot of the conclusions that I was, nobody cares what I think, but that's sort of where I was too. I thought watching the 10-year makes me think that now cuts are definitely in the cards now. And I didn't see why there would be cuts prior to this. But
they have tightened financial conditions dramatically that will have an impact. We're already seeing that the housing market is completely unaffordable. It's actually at the lowest level of affordability since they started looking at the data going back to 1986.
Now they're even talking about cuts to rates on CNBC because of how much the long end of the curve has risen. And I get it. You guys are equity investors. I doubt many of you guys own bonds. I don't own any bonds. But this is important to understand and stay up to date with if you are an equity investor, because bonds are the single biggest thing that affects equities. Right alongside earnings, it's the bonds, your risk-free return. It's vitally important to understand if you are an equity investor, if you're invested in Tesla, or really you're just invested in anything in our markets or even real estate and other asset classes. The bonds are very important. And what is going on right now? Well, it's not great. Tomorrow's data, coming out tomorrow morning, is also going to be huge for our markets and will send the markets up a lot or potentially down a lot. Here's my expectations. So on Wednesday, we got the ADP employment change. That came out at 89,000 jobs. You were expecting 153,000 jobs. Now, the head of ADP said they do not factor in the UAW strikers as unemployed, but the BLS, the government non-farm payroll report, might. So we got 89,000 jobs on Wednesday. That's usually where the government report comes in as. Now, it could be even lower for the government report if they do factor in these strikers, which is about 17,000 currently, into this non-farm payrolls report. So the market's expectation is around 170,000 job ads. The forecast on the lower end is about 150,000 job ads. If we look at the last couple of months, you were around 105 back here in June, 157 in July, and 187 in August. The ADP, the head of the ADP that collects this data and gives us this report, said September was a very weak month relative to July and August. So I have to think that we're probably going to come in lower than 170,000 job ads. So my expectation is actually closer to 100,000 job ads, maybe 110,000 job ads, and that could give the markets quite the rally actually tomorrow, because that would probably send down yields, because then markets would say, hey, maybe we don't have to be so much higher for so much longer, and tomorrow could actually be a bullish event based off this. Now, it's hard to say how these government reports are going to come out. If we come in line with expectations or even higher than expectations, what if we're over 200,000 job ads? Then the bonds could really become de-anchored and start to fly for your bond yields, and that could also be a big negative. So this job report has a lot of implications to the bonds, which is directly affecting the markets. What we've seen over the past 2 weeks or so is when bond yields are up, stocks are down. When bond yields are down, stocks are up. So hopefully this makes some sense. I think in line with expectations is not good enough. It's not weak enough to get the bond yields to fall. Thus, that could mean equities could fall. So you really want to see a big miss here to get bonds to fall, to get stocks to rise in a big way. So if you're bullish, that is something that you should be hoping for, is a weak jobs report tomorrow. But you also have the unemployment rate, which is expected to come in at 3.8%. Last month's rating was also 3.8%. So again, this is one of those things where you want to see this go higher, but not too high. So 4%, that's probably okay. Anything higher than 4%, that's where you might start to get a little bit of worry in this market, although that would probably have a good effect on bringing down yields. Investors are going to start saying, hey, are we heading into a recession if unemployment just went from, 3.3% this year to 4%? That kind of rise historically has always happened right before a recession. So you're really at a fine line here with some of this data between being too bad and being too good that'll keep the Fed higher for longer. So any big move, any big miss, I'll say here, from the expectations is going to cause a big move in the markets. Now, as you can see, the Nasdaq was not too happy today. You dropped about 1%. Tesla stock was down about 1% as well. Tesla tends to be pretty reactive to bond yields. When bond yields go higher, Tesla stock tends to go lower because Tesla is deemed a riskier asset in the markets. But Tesla stock here recently has been rising, and I think someone somewhere knows something. And really what I mean by that is you're probably going to get the Cybertruck here pretty soon. I think we're just within potentially days away from getting an announcement. There's been a lot of speculation that maybe tomorrow is the big day for the Cybertruck announcement. It's obviously not the event tomorrow, but maybe we get the announcement tomorrow and then we get the event maybe end of October, beginning of November. We start deliveries a couple weeks after that. That would put you probably towards the end of November, beginning of December. We actually start deliveries of the Cybertruck. That could make sense to me. That is a possibility. Tesla stock rallied about 6% yesterday, showing a lot of strength today. But if the markets react negatively to the data tomorrow, well, Tesla stock's probably going to react negatively as well. As If we get the announcement for the Cybertruck, though, that could offset some of that, and I think Tesla would be able to move a little bit more independently, potentially take an even higher leg up. That's my expectation. You probably rally 7 to 10% when the Cybertruck delivery event is actually announced, as the markets really haven't given any kind of valuation to the Cybertruck itself. Investors really haven't given any credibility to the Cybertruck. We've been waiting on it since 2019. Why would they? Why would they factor in Cybertruck deliveries in their, models for valuing Tesla? It doesn't make sense. But when you actually get the event and the day for actual deliveries to start, that's a little bit more concrete, and I think investors have to take notice at that point. So if the event is announced tomorrow, well, that would be exciting. That's obviously not a trading thesis. You want to be more reactive than proactive when it comes down to trying to time events with Tesla, and especially coming on a day like tomorrow when you have a major jobs report that is due. It's hard to say what's going to happen, but if you look at the technicals here on Tesla, they look beautiful. Tesla's above your 8-day moving average, your 50-day moving average, your 100-day moving average, and your 200-day moving average. Only 7% of the S&P 500 is above its 50-day moving average. 7%. Tesla is in that 7% camp. That's wild. Tesla is massively outperforming the markets, something that you have not seen in a very, very long amount of time. Now, I do also want to play this clip from Nick Timiraos. He is one of the guys over at the Wall Street Journal that is like the Fed's mouthpiece, to let you guys hear what he just said today about future Fed policy, that this could be somewhat bullish for the markets.
Joining us right now is Nick Timiraos. He is the chief economics correspondent at the Wall Street Journal. His latest article is titled "Bond Sell-Off Threatens Hopes for the Economy's Soft Landing." Also, Brenda Vignello, who is Chief Investment Officer at Sandhill Global Advisors. Welcome to both of you. Nick, let's start talking about what's happening with this rise we've seen in interest rates. There's been a lot of speculation lately, including an article from Kevin Warsh today in the Wall Street Journal, an op-ed that suggests things have really become unhinged and the Fed is not controlling it at this point. It's bond market investors who are doing that. What do you think?
Yeah, no, Kevin raises a fair point. I mean, this looks like you've had a rise or a shock here in term premium, and it's not clear what the Fed can really do at this point if that's what is driving this. By one hand, this is what the Fed has been wanting to see all year, tighter financial conditions, but it's a little bit, Becky, like hitting that glass ketchup bottle. You keep hitting it, nothing comes out, and then everything comes out all at once. And at some point, exactly, all over the tie, and you're not sure, at what point is the Fed going to say, okay, this is enough tightening in financial conditions? So I'm with Steve Leisman in the last segment. I don't expect to hear an immediate change anytime soon. You're going to have to see the data weaken or some kind of market accident to get this to stop. If this was Fed-driven, then Fed words could change it. But I don't see why they would step in here at this point.
Would they step in, or I guess does it at least mean that they're not going to hike rates again? They don't have to do that because the work's already been done?
That's just it. So, the case for a November rate increase is going down because you've gone up 50 basis points in the 10-year Treasury in the last month. You've gone up almost a point since the last rate increase in July. And so the case for raising rates in November, it already seemed pretty weak. I mean, Powell at the last press conference 2 weeks ago saying proceed carefully 6 times. And December's still a long time away. There's still more data to come out. But if we sustain these tighter financial conditions, then the market is finally doing the work of the Fed. And so it means the Fed doesn't have to do as much.
Hey, Brenda, we watch every time interest rate yields go up. You can see the inverse reaction for the equities. Right now, Dow futures are indicated off by about 130. Is this simply the idea that, look, the stock market looks less attractive if you can get a much higher yield on a longer term investment?
I think it's that, and I also think it's what Nick was just alluding to, and that is that with interest rates higher, that that puts more pressure on the economy potentially. So there is a risk that we do see more of an economic slowdown happening. Certainly not seeing it in the current moment, but that's certainly a possibility. But I would say, when you look at how you're going to allocate assets, when suddenly you can lock in yields of around 5% on the 10-year, which thankfully would come down a little bit versus where we were at a few days ago, but that creates competition, especially when you look at an individual investor in a high tax state. You can buy a treasury bond, it's tax advantaged, and lock that yield in for a long time. And if inflation continues coming down, that real yield just increases. So I absolutely think that it creates more competition in terms of assets, trying to find a home that will deliver a decent return, and who can argue with a risk-free return.
Nick, how does the Fed look at this? Are they relieved that the market is kind of doing its work for it, or are they worried because they've kind of lost control?
Well, that's a great question, Becky. I think the Fed prefers to see things unfold orderly. And obviously, market conditions, the traders I talk to say that, conditions are orderly. This sell-off has been happening in an orderly manner, but it's rapid, right? And so, the Fed, before the next meeting, they're going to get another economic forecast from the staff. It's in the Teal book. And if you go back and look at 2013, July of 2013, when we had just had the taper tantrum, they're going to get a set of projections about what this increase in yields, if it's sustained, if you have a higher positive term premium, what is that going to do to inflation? What is that going to do to unemployment? What is that going to do to growth? That's going to have an effect. And so they have to worry at some point about getting more than they bargained for. And I'm not suggesting that we're there yet, but you don't want to see things happen just kind of snap of your hands. You'd rather see it happen over maybe a little bit longer period of time.
Nick, do they have the ability to temper market sentiment with their words? We just were talking to Steve about that. That
Yeah.
if it were to get out
question.
He thinks that they could take 50 basis points off by, I don't know, just even admitting the possibility of a cut at some point in the future. Other people think if it gets totally unmoored, that the Fed's, that the bond market's going to do what it's going to do, no matter what they say, if it gets bad enough.
I guess I'm not as convinced as Steve is, and I respect Steve a great deal, but I'm not as convinced as he is that this was caused by the Fed, or that the Fed could come out and say something and fix it, or that they would want to. I mean, they've been talking about higher for longer. They've been talking about running off their balance sheet even after they're cutting. And so to do something now to change that, it could look panicky. People are out there talking about, are they going to change QT? Why would they do that? Unless there's some sort of market disruption and a serious one. I mean, remember, this is a Fed that hiked through a banking crisis or ruckus, whatever you want to call it, back in March and May. So I think the bar is high here for them to change things. Could the leadership come out and provide more soothing words at some point? I guess that's a possibility, but it risks looking like an overreaction at the same time. So I think they're in a very kind of tricky spot right here if this sell-off continues.
So if you're right, we're talking about increased rates, nobody lowering rates in the next 12 months.
Yeah. And maybe for several years, right? Like, I think that's what people are having a hard time thinking about, is rates could stay up for 5 or 4 years.
If that's true, then equities are wildly overvalued.
That's true.
That's true.
It is true.
Okay.
You would think Bitcoin would.
But then I would think that crypto would be wildly overvalued too.
Yeah.
So equities probably are overvalued because the PE is the same level it was when rates were crashing, but now rates are much higher. And if you took the normal equity risk premium for equities onto a 5% 10-year note, they should be 23% lower than today.
Wait, equities should be 23% lower today?
And
You're talking about the S&P?
The S&P, yeah. And if you took it compared to its 50-year average of equity risk premium, it'd be 43% lower. And I'm not saying 43 is going to happen, but we got to keep in mind there have been 2 13-year periods that equities didn't go up in the 2000s and in the 70s, 80s. We could see that.
You think 23% is going to happen, if not 43?
I think equities are going to go down for the next few years. And that's why crypto is relevant, because it's not tied to interest rates. And that's pretty rare, right?
Well, that's a pretty stark warning. If we were to see a pullback to that degree, 23% here, let's call it on the NASDAQ. That would put the NASDAQ down. Geez, not even that bad. Down to about 275, almost to the lows that we seen back in September and October. 23% down on the SPY would put the SPY down. Let's see. It's going to look a little bit worse than the NASDAQ. That would put you down to about pre-pandemic highs. So erase the last couple of years of gains for the market. That would be down to about 323. And that's just saying that's where the equity risk premium says stocks should be. So I think this even makes us a lot more prone to any of the economic data that we get that really reiterates higher for longer, or even maybe that the Fed should actually start cutting rates sooner. That's also a possibility. They wanted to affect the long end of the yield curve, but I doubt they wanted to have this kind of an effect on the yield curve. Matter of fact, ECB's Villeroy says he hopes interest rate hikes are over. He says it's too soon to talk about cuts, but the rise in long-term rates has been unprecedented. The speed in which, specifically, he says, has been unprecedented. And I mean, that's true. The Fed has hardly raised rates recently at all, and the 30-year Treasury has increased over 1%. The markets have finally realized higher for longer is here, and the Fed's not bluffing, pretty much, as far as we know. Oil today is continuing its decline, down 1.64%. KRE is up 0.25%. Those are both positives for the market. And if you look at the dollar today, I don't know why you always have to like fully refresh this to get an accurate reading. The dollar is down about 0.25%. These are all positives for the markets. But yet, stocks cannot find a rally today. The Nasdaq's still down about 1%. I mean, that's pretty rough. You would think with everything going the way we would expect, besides TLT being down 0.25% today, give or take, 0.5% give or take, you would think that would be enough to at least be flat on the markets today. Maybe not a face ripper rally by any means, but not down 1% on the NASDAQ. This is just not a great sign. But again, the Cybertruck could be right around the corner. Specifically for Tesla, that could be really good news to come. So that is going to do it for this video. Hit that like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. Again, if you guys want to come trade with us live in real time, get access to all of my trades that I make every time I make a trade, link down below in the description of this video. My name is Michael Tyler. Enjoy the rest of your day and night, and I will see you in the next one.